So this is example one of a bank reconciliation. What you need to have in front of you are the notes, because I don't have room enough to have the problem itself plus the solution on my whiteboard. So let's look at the information that's given. They start out giving you information on the cash account for the Minton Company. This would be your book information. And what you're looking for is you're trying to reconcile the bank and the books at September 30th. So you have to pick out what information you need here. They're just putting a bunch of stuff in to confuse you. I mean, you could think of it as you walk into an office and the desk is covered with stuff. You're not going to use all that stuff for whatever you're doing. You're going to have to pick and choose what you need for what the little project you have in mind is. So all we really need here is the balance September 30 of 17,404, and that's going to be your balance per books. So we're just kind of going through rummaging through the problem here, picking out the information that we need. If we go down a little bit, they say the bank, they give information from the bank statement for the company. So this is what's on the bank statement. And they say the bank balance at September 30 was 16,422. Well, we need that, 16,422. Okay. And what else happened at the bank? These are all things that the company doesn't know about. So we're going to have to tell the company about what happened. Okay, so this is the bank balance. That goes over here because that's the balance per bank. But then the collection of the note receivable, the bank already knows about that, and that's reflected in this number. But the books don't know. So it says collection of a note receivable for $2,500. So we would say we got to add that in because we don't know, the books don't know about that. All right, and then it says there was some collection of interest on the note of 30. Okay, so we had some interest revenue connected with the note of 30. Right. It says there was interest earned on the checking account, so we might want to put interest revenue on the note receivable, and then we've got interest revenue on the checking. Okay, and that was 45. Then we come down to other things. Let's see, there was a non-sufficient funds check from one of our customers. Well, this is money that we put in our deposit. We thought we had that money, but we don't because the customer didn't have the money in their account. So we're going to have to take that off. So we got a non-sufficient funds check, a bounce check for $475. So that's going to get deducted. And then what else? Oh, the safe deposit rent. So that's a charge that we also got deducted from our account that our books don't know about yet. So we have to deduct the $65 for that. Okay. So that really gives us, and let's see, we're missing something over here. We've only got the beginning balance per bank. Deposits in transit we have to add. Well, they give us that of what, $54.50. So we're going to add the $54.50. They also give us the amount of the checks outstanding of $23.83. So we're going to deduct $23.83. All right. Now, there's no way I can do math in my head, so I have to go down here, make sure we haven't missed anything. We started out with the balance per bank of the 16,422. We add this, we subtract that, and we should get 19,489. Okay. Then we come down to the book side, and when we add and subtract all of these, we get 19,489. What a coincidence. Okay, so this means that we have reconciled the balance per bank with the, balance per book. So our adjusted balances are equal. However, we're not done yet. We're done with the reconciliation part, but now we have to tell the company books about everything that happened over here. This is the balance on our checkbook right now. This is what it should be. So as a result of the bank reconciliation, we have to make some journal entries to tell the books what happened. So the cash went up by these three amounts. So as of, I guess we're working at 9:30 here. Okay, that's not weird. So what account, we have to use actual account names here. So the account would not be collection of notes receivable. The account would be notes receivable. We would use interest revenue as an account. So the first journal entry, we're increasing cash, so we're going to debit cash, and we're going to be crediting the note receivable. Okay, and that would be for the 2,500. And then we would be crediting also our interest. It's hard to write down this low, but that's all right. Interest revenue. And I'm going to put those together at 75. Okay, and so cash would be debited for 25.75. And then we have to go over here to make the other journal entry. And so we would go date, and here's our debit, and here's our credit. So we've accounted for the increases, now we account for the decreases. NSF check is not an account. That would be increasing that particular customer's accounts receivable. So we have to add back that accounts receivable because we didn't really receive it because the customer didn't have any money in the account. So that's got to go back for 475, right? Safe deposit rent, this could be, a miscellaneous expense or office expense or whatever the proper category was for the company you're working for. That's 65. And then we would be crediting or reducing cash for 490. Okay, so now if we had room, I could do a little cash ledger to show you, but you can do it on your own. We had a cash balance of 17,404. When we add 2575 and take away 490, we should end up with the proper cash balance. And the company books now know what happened with all of the, as a result of the bank statement. Okay, so that's the first bank reconciliation example. The second one, we get into a little bit more detail, probably a little bit more real world, because it has some errors on it. Okay.